Welcome to XYPN Radio, where your host Alan Moore brings you into a community of fee-only financial planners who want to profitably and successfully serve Gen X and Gen Y clients. If you're ready to get the knowledge you need from leaders in your field, learn from forward-thinking advisors, and take action on your own goals, XYPN Radio is the show for you. Here's your host.
Hello and welcome to this episode of XYPN Radio. I'm your host, Alan Moore, and today I'm excited to welcome Scott, the founder and CEO of First Ascent Asset Management, on the show. First Ascent has come on the scene as the first asset management platform that charges a flat fee instead of an asset-based pricing. It was really fun to chat with Scott about his experience bringing this service to the marketplace, because the things, quote-unquote, industry experts told him about how stupid his business model is were the same things we were told when launching the XY Planning Network. Why charge flat fees when you can take a percentage of revenue? You're leaving so much money on the table. This interview is a lot more than just an overview of First Ascent. It's a story of being an entrepreneur and trying to disrupt an industry so solidly stuck that the process is a lot harder than it appears. If you'd like more time to spend with your clients, First Ascent Asset Management can help. First Ascent builds and manages investment portfolios for independent financial advisors and their clients for a flat fee of $500 per account. This industry-first approach to pricing makes professional investment management affordable for everyone without sacrificing quality. First Ascent's 7-member investment committee includes 5 CFAs, a PhD, and a CFP who collectively bring decades of experience, objectivity, and fresh perspectives. First Ascent offers a variety of portfolios designed to produce solid long-term performance while keeping internal expenses and trading costs low. First Ascent's high-touch service team stands with you as a resource to provide guidance and to make account opening and servicing the accounts easy and hassle-free. They also offer a streamlined technology platform to facilitate proposal generation and paperless account opening. Visit their website at firstascentam.com or give them a call at 720-465-7888. You can find any of the additional resources that we mentioned during the episode at xyplanningnetwork.com/91. Also, be sure to go to xyplanningnetwork.com/VIP to join our private group just for XYPN Radio listeners. You'll find a discount code to attend XYPN 17 in August, a can't-miss event with over 500 advisors expected this year. Early bird pricing ends at the end of March, so get your ticket today. Without further ado, here's my interview with Scott. Hey, Scott, welcome to the show, man. Thanks so much for being on.
It's my pleasure, Alan. Thank you very much for having me.
So I am really excited to chat with you because if there's one thing I love, it's people that blow up the norm and the industry norms, which we are most certainly doing on the financial planning side. And I'm excited to see and talk through some of what you're doing to blow up the norms on the investment management side. So I appreciate you being able to come on. So let's take a step back and just sort of talk through what it took for you to get to where you are. So have you spent your entire career in financial services?
Yeah, I started out in a much different part of the financial services world, though. I started out as a lawyer in Washington, D.C., so I was actually interned at the SEC while I was in law school for a while and practiced law in Washington, D.C. for 15 years or so. And doing most of my work in financial services, I did a lot of work with asset management firms, pension consulting firms, did a lot of work with ERISA, venture capital transactions, and so forth. One of my clients was in the asset management business. And about 25 years ago, I guess now, it seems like a long time ago, I went to work for an asset management firm. And it was one of the first firms to provide outsourced investment management services to financial advisors. It was called Adam Investment Services. If you're old enough, you might remember that firm.
I do not, but it's funny how things sort of get started and then build on each other. But did you go there as an attorney to do more legal work, or did you go there as more of an advisor or investment manager?
Yeah, I really started out as more of an attorney. But I knew this client very well and they knew me very well. And so they always had some other projects for me to work on. And, eventually, I guess within a few years of being there, I was the president of the firm. So I kind of grew out of my lawyer role and then into more management responsibilities. And then Adam was purchased by PMC, Portfolio Management Consultants, which is now part of the InvestNet organization. So I moved out to Denver with that transaction, and within about a year of arriving there, I was the president of PMC. So that was kind of my second asset management firm. And actually, I won't go through the whole sordid history, but First Ascent is actually my fifth asset management firm that I've served as either president or CEO. And so doing this, all of the asset management firms I've worked at have been serving financial advisors. So this is, part of the world. I did not grow up, imagining that I would work with independent financial advisors as an asset manager. I didn't really know what an independent financial advisor was, until I got into this business. Now I've been in this world for quite a long time and just love it. It's kind of, however I got here, it doesn't really matter much. This is kind of my destiny, I guess. So I left the firm that I was at before I started First Ascent. I had all of these ideas about things that I wanted to try to do differently. And First Ascent really is kind of the culmination of all of those ideas.
There's something just fascinating to me about people's career paths. And I love highlighting just how varied they are, because none of us are where we thought we were going to be when we were 18 and going to college, or 22 and graduating college. And for folks that say I'm not sure about law school because, I'm not sure if I want to be a lawyer my whole career. You just don't know where you're going to end up and the opportunities that will present themselves. And the flip side being, be open to those opportunities. And just because you went to law school doesn't mean you have to be a lawyer for your entire career. Probably learned a bunch of stuff that saved your tail and saved you some money by, having gone to law school and been a lawyer for a while. But it doesn't mean that you can't go on to be president of an asset management firm because you went to law school.
Yeah. Well, yeah. I mean, interestingly, the internship I had at the SEC, I wanted to go in and work in the enforcement division and put bad guys away and all of that. They sent me to the Division of Investment Management, which is the division that regulates and works with mutual funds and investment advisors. So, it turned out that was, at the time, I wasn't really happy about that assignment, but it turned out that I learned a huge amount about the world that I have operated in for the last 25 years by being there.
So your story is very interesting, and it's something that we've been touching on or trying to touch on more recently with various guests on the show, and that is sort of getting into this role of manager instead of doer, which, for the independent advisor, for the most part, I think a large majority of us will stay solo advisors or smaller advisors. We continue to practice and do the financial planning. And we hear from a lot of folks that say, I want to scale, I want to grow, I want $1 billion under management, without really recognizing what life looks like whenever you get to that point. And so I had an interesting conversation with Kitsis recently where, we're saying that, with XYPN Network, I'll admit that there was a time at which I stopped having fun because I stopped doing the work I got into started this company to do, and started just managing people that got to do all the fun stuff and the not fun stuff. So can you talk to us a little bit about that transition for you? I mean, was it just sort of natural for you to get in there and take on that leadership role, or was that, sort of a learning experience in and of itself?
It was natural progression for me to do that, although I still have a lot of the experience that you just described, where the things that I really like doing, I look at longingly and try to figure out a way to get back to those as soon as I can. And so it's one of the luxuries that we have here at a relatively small firm. And also, at the firm that we have now, the individuals who work here are all people that I've known before, worked with in past lives. And so I don't really have to do very much management anymore. They're people that are very experienced and they know what their roles are. And I get to, head off to my office and do the things that I'm more like to do. So.
I love it. Well, we'll circle back to talk about this a little bit more, I think. So you decided to make the leap. And so is First Ascent the first asset management firm you have actually started?
Yeah, all of them have, I've been involved from the sort of early stages, the beginning of the firms, each one of them, with the exception of PMC, which was already pretty good size when I arrived there, all of them have been relatively small. But this is the first one that where I really just started myself. There were always other people around. I was part of a team starting the other ones or trying to grow them from very small to bigger. But this is the first one where I was just sort of wandering around with all these ideas in my head and talking to my friends and colleagues. And at some point I realized I was getting a lot of positive feedback about the ideas that I had. And so I thought, well, I'll just start a company and we'll see where it goes. And so that's certainly the first time that I've ever really just started with no assets under management, no team, no infrastructure, nothing. Just kind of tried to create it from scratch.
I think that's the same entrepreneurial journey many of us went on, which was, really looking at the space and saying, hey, I have all these ideas. And I think most of us went out looking for an opportunity to leverage those ideas inside of an existing structure, because that comes with a salary and some backing, which is nice. And you don't have to go out and find the first client and that sort of thing. But sometimes you're just a little too outside the box, looking for a little too much or asking for a little too much flexibility, or, taking control away from the owner that's going to be paying your salary and that sort of thing. So did you see opportunities to leverage these ideas inside of other settings, or was it just so far outside of the box that you knew, you're going to have to do this on your own if you really wanted to do it your way?
Yeah, well, some of the ideas were ideas I had tried to interest my partners in at my last firm, and they just weren't that interested in them. So, and then some of them came about after I left the firm. So some of the ideas were things that I developed really just because I had more time on my hands. When you're at a job and you're working hard, you have your nose down, and you're working pretty furiously. But when you have a little time off, which I had when I left the last firm I was at, I had the luxury of just being able to think about things and ponder things and talk to people about ideas. And so, so part of it was from days gone by, and part of it was ideas that came up as I wandered around just thinking.
I think that's going to resonate with a lot of our listeners, just because sometimes the best ideas come when I'm on the ski lift, for 15 minutes heading up and just thinking like, why do we do it this way? Or like, why can't I do this thing I really want to do? It's really interesting to me because you've taken, again, you're sort of doing in the investment space what many of us have been trying to do in the planning space, which is say, what would we do if we didn't have any legacy data? Basically, no legacy expectations, no, this is how it's always been done. And you may get some of that from, well, this other provider, your competitor does it this way, but nobody's saying, oh, but you used to do it this way, which is super nice, but also terrifying because you don't have anything to work from. So start us off on sort of the ideas that you had. When you were either at that last firm or sort of, after you had separated, sort of processing out these ideas, what was it that you were thinking, hey, I want to do it this way? And some of our listeners may not be all that familiar with the outsourced investment management offering. So maybe, compare and contrast that to, some of the bigger players maybe that are out there and how they handle things.
Exactly. Yeah. So business that we're in is providing portfolio management services to financial advisors. And so our clients really are the financial advisors, and they bring their clients' assets to us and we manage them. And historically, the management of those assets was been done in pretty much the same way that you would find at any large asset management firm. And, the most obvious idea that's different about our firm is, one of the things I was thinking about was the whole fee structure thing. And so I'm not, you guys as a group are, we're way ahead of my thinking. In the asset management world, though, nobody was using flat fees or retainers or anything like that. It's always been percentage of assets under management. So as the technology has changed in our business, there's been less and less justification for that approach. It doesn't take us any more work to manage $1 million portfolio than it does a $100,000 portfolio. I mean, really, they're the same as far as we're concerned. And so I started wondering about why we were all charging assets under management fees, and I couldn't really come up with any good ideas. I mean, I had a couple of ideas, but they weren't very satisfying. I thought, well, maybe we're doing that because the liability associated with big accounts is greater. But I thought, well, that's kind of wrong to charge your clients more, to cover, as an insurance policy in a sense, in case you make a mistake, that you're insuring yourself against your own incompetence at your client's expense. So that didn't make much sense. And then I thought, well, maybe it's because, we're adding so much more value for the large accounts. And I thought, well, I could see somebody saying that, but it's really not what happens. We don't have control over the markets, and, the fact that an account is large or small is not within our control either. So, we do our work, and it benefits small accounts, on a dollar basis, less than large accounts, but it doesn't seem like that should be a justification for these vastly different fees that the clients pay. So the flat fee idea just made huge sense to me. And the challenge for us was to, just try to figure out what that flat fee ought to be, and to be able to, have it work for a large number of accounts.
Yeah, it's interesting because as you were talking, I was thinking that I think the justification, the argument is values based, right? That if you have $1 million, I'm providing you a lot more value, I guess, as a client. So therefore you pay me more. It sounds like you're sort of separating what you do and what the advisor does. And really that you're not trying to beat the market. It doesn't sound like. So you're not trying to provide that alpha. And the advisors really want the one that's there providing behavioral management, which is, really the valuable piece of investment management, is staying on track. Don't sell at the bottom of the market. Don't do anything stupid. And so that's not really captured in an AUM fee on your end.
Yeah, exactly. And the other side of the argument is, if it's all the value you're adding, that's justifying the higher fee, then what about when the market's going down, right? Because a big client suffers more also, so shouldn't your fee be even less than the small account, when you're a big account? So it just, the rationale just didn't seem to be there for me. And so, I saw, both an opportunity to benefit the clients that we work with pretty significantly, and also just a great business opportunity. It was, I thought, well, we all work so hard to find some basis for differentiation in our businesses, right? And here was the perfect opportunity to do something that nobody else was doing. I mean, literally, there was nobody else on the planet who was doing it this way. And so a pretty good win-win for everybody.
So I know as an entrepreneur, it's really exciting to step off into the let's do something no one else is doing. But then you also have to have that thought of like, is there a reason no one's doing it this way? Which in financial services is a little easier because our industry is so slow to try anything new that it's a little easier here. If we were in like, fintech or something, it's a little different because then you're like, okay, maybe there's a legitimate reason no one stepped off into this. But I guess what was the pushback from your peers in the asset management space? Was it simply that, hey, you're not going to be able to actually scale this thing, or, you're just undercutting your profit margin? You could be charging more, so why not? Like, I guess why have people been so reluctant to go with this service model? Yeah,
well, it was a kind of an interesting journey for me because, I started asking myself the question, first of all, and then I asked other people, and people they were all blank-faced. It was like, what?
Like they'd never even thought about it.
I'd never thought about it. And really, it's kind of embarrassing to say because I've been in financial services now 40 years. I had never thought about it until I got, a little time off. And all of a sudden, here's this thing which is, a major feature of the industry that I've been working in for a long time. And I'd never questioned it. And that was really the reaction I got from most people. They were sort of dumbfounded at first. And they said, well, actually, that's a good idea. That makes sense. And then I started getting the kinds of responses that you would expect, which is, why would you do that? You're just giving money away. The other thing was sort of a fearfulness, that it was like, well, if you do that,
please don't make me.
Yeah, that might affect my world. And I kind of like my world right now. So it has been, a kind of a fun, exhilarating experience to step out into an area that nobody's been. Since we have no role models, really, we have to do a lot of the thinking and the planning just based on our own intuitions a little bit and our own sense of, I guess our experience in the industry, but just trying to figure out how this is all going to work.
Yeah, I saw Dick Wagner, who's sort of a financial planning theorist, I guess, speak one time, and he talked about the sacred cows of financial planning. Basically in reference to what are the things that we refuse to get rid of and that we hold dear and don't even necessarily realize that we are. And again, like it's this just sort of assumption that we will charge an asset-based fee. And we see this in financial planning all the time where, we tell consumers, hey, we're going to charge you $150 a month for financial planning. They go, okay, like everything they do is monthly. It doesn't even occur to them that there might be another business model. And yet when I tell advisors $150 a month, and it's getting slowly better because we've been around coming up on 3 years now, but like up until this point, it's still been this sort of wild, crazy look like, what do you mean? No, you're supposed to charge on assets. It's like, yeah, but what's 1% of nothing? It's nothing. So we can't charge that to people that don't have assets. So therefore there has to be a different service model. And it is kind of amusing to watch people sort of think through and go, I've never thought of that. Like that is interesting.
No, it really strikes people as a unique idea if they haven't thought about it. And I just think most of the industry up until fairly recently hasn't thought about it very much. And, that's certainly true in the asset management. Yeah.
From a business perspective, and we dealt with this with XYPN Network, right? As we launched, we said, we're going to charge a flat monthly fee. We're not going to take the broker-dealer model of a revenue share. Now, revenue scales a lot better. It sucks in the beginning because, again, 0% of no revenue for a new firm is zero, but it scales well over time. So we sort of took this flat fee approach as well. And the concern is always, how do you scale and how do you raise fees? Because there comes a point at which that flat fee is no longer appropriate because of inflation or added services. And AUM is just such a natural thing, right? It just goes up over time, assuming markets go up. It just sort of goes up and no one really questions it. You don't have to let them know. So obviously you're new to this. And so in 10 years, it may be a different conversation. But do you have any concerns around the ability to raise fees in the future, or how the structure will work in the long run as you scale and need more management layers and operations layers and non-revenue producing sort of components of the business?
Because we're doing something that's so new, we are very aware of the fact that all as we sit here and plan and think about what's going to happen in the future, we know that we could be wrong, right? So we do think about what would we do if we needed to raise fees and how would we go about doing that. But really, most of our thinking is in the opposite direction. It's thinking, okay, so once we get to a certain point will be large enough to lower fees. So what does that point come along? Because really, we've always had it as a goal to try to introduce flat fees to asset management and keep those fees, becoming more and more reasonable. So if we in effect have built a really good and efficient portfolio assembly line, that's basically what we're trying to do is build a firm that looks fundamentally different than the typical asset management firm and just is very efficient and very streamlined, then at some point we should be able to lower fees and still make a good profit for our firm.
That's awesome. So we've been sort of dancing around it. So I guess let's just define what we mean by flat fee. So can you explain the actual fee structure that you use with your advisor accounts?
Yeah. So we charge $500 a year flat fee. So if you have a $100,000 account, that $500 fee translates into 50 basis points. If you have $1 million account, you're still going to pay $500 a year, and that's 5 basis points. So it's just the same flat fee no matter how big the account is. The things that we had to deal with was, well, what about small accounts? Because, once they get down to a certain size, let's say, $50,000 or even $25,000, even a $500 flat fee starts to be a lot if you translate it into basis points. So what we do there is we charge a 50 basis point fee for smaller accounts. And then once the account hits the $500 number, it just gets capped and never goes up from there.
That makes sense. So do you have any type of account minimum in order for it just to make sense?
Yeah, $25,000 is where we've set the minimum.
Sort of hit that line. So $25,000, it's a 50 basis points, and then it goes up to $500 or $100,000 is sort of the crossover. And then beyond there, no additional fees.
Yeah. And we are, just parenthetically, we are trying to work on some solutions that will allow us to bring the account minimums down below $25,000, but we haven't quite got there yet. So.
And now I remember when I had first checked you guys out, you had a little bit different of a fee structure, and it was it was sort of the same concept, but a bigger range, right?
Yeah, that was an interesting story. So this is again part of the whole, the exploratory nature of our journey. We started out with a capped fee. We capped our fees at $1,500. So the cap wasn't reached until an account was at $300,000. What happened there was, it was really interesting. Advisors liked the concept of what we were doing. They thought it was really interesting. But most of the advisors that we talked to, their average account size is lower than $300,000. And so the cap just wasn't relevant for them to the extent that, it caused them to want to switch whatever they were doing and come work with us. So at the end of last year, we were working with a few advisors who were kind of really, frankly, they were just being slow to move assets over to us. And we tried to give them an incentive and said, hey, look, if you move over these assets by the end of the year, we'll charge your clients a flat fee of $500. And immediately they moved their assets over. And we said, hey, we may be onto something here. So we had always had the idea of going to a flat fee, but we just didn't think we would do it quite this early. So through January, we kept the experiment going. And I think 13 new advisors signed up to work with us in January. And basically it's just it was pretty obvious that we had dialed in a formula that was going to work much better for the advisors that we were interested in working with. And so we just adopted the $500 flat fee. Just a week or so ago, I think we sent out a press release about it. But we've been experimenting with it now for a couple of months. And that's how it works. It's the simplest fee structure you could possibly imagine. $500 flat fee every year.
So when did you launch First Ascent? I mean, I guess when did you first take on your first advisor?
Yeah, so I actually technically started the firm in August of 2015. That's when, the LLC was formed. I was a registered investment advisor by January of 2016, and we opened our doors for business at the beginning of June. So June 8th, I think, was when we first opened up. And we were still building things. It was like, if you can imagine a play, and the first act is about to start, and the actors are still backstage, putting their clothes on and practicing their lines and so forth. So a lot of 2016 was really, we were still, putting things in place and building infrastructure and so forth. But so we were open for business, brought on a few advisors then, but I think we were really technically ready for full-blown operations in January of this year.
So I love it because essentially what you did is 6 months in, you made a major pivot. I mean, you went from a $1,500 account maximum, which I'm assuming you had some projections that had that coming in on the revenue side, and said, you know what, let's make the move to 500. And I think that that's really hard for entrepreneurs to say, hey, maybe we got the pricing wrong. Like maybe the model was right, everything was right, we just got the number wrong. And we're reluctant to make that shift. And sometimes we wait too late to make it. So I commend you for being able to do that, especially so early on, and to be able to sort of see that need, because as advisors are starting their firm, they may have to make that move as well because they may have just priced themselves incorrectly.
Yeah, well, that's very insightful, Alan, because we really agonized over it. It seemed like we had just launched the firm yesterday, and we were
slashing fees by 66%.
Yeah, a radical change. And so we were all looking at each other, scratching our heads going, should we do this? Is this the right thing? But it was one of those things where it felt like the market was really talking to us. It was really saying, hey, look, you're going to get a lot more interest if you price yourselves this way. So then we had to go back and, look at our financial models and our all of our projections and say, could we do this? Is this, a sustainable business? Is it a viable business model? And we tweaked a few things here and there. And sure enough, it looked like something that would work well for us. So we plunged ahead. And I think even as we were doing it, we were all, sort of holding our breath. I think we're all very happy that we made the move. And it took some courage, but I think this is going to work well for us and for the advisors that we work with.
It's also the beauty of not having venture capital backing you. I'm making an assumption here that you don't have venture capital behind you, but if you did, they would not have approved.
I think that's right. I mean, this is one of the things when I look at the robo-advisors, for example, I just think I would hate my life, having $100 million of somebody else's money.
And being told to 20x it. Good luck.
Exactly. Yeah. Good luck with that. So.
Yeah, no, that not a world I would want to be in either. So you have this $500 fee. Is it charged on a monthly, quarterly, annual basis?
Quarterly basis, yeah.
Okay, and is it typically charged directly to the client, or is it charged to the advisor?
Yeah, it's charged to the client. We can do our fee. Typically, it's charged to the client. We use TD Ameritrade as our custodian. We can debit the accounts. We debit the account for our fee and for whatever the advisor fee is, and then we send the advisor their fee. That's the typical arrangement, but there are a number of variations on that. So we've got some relationships where people do their own billing and send us the money and so forth. So there's a little difference there.
Okay. Yeah, because that's another piece too. I think advisors are sort of getting used to is like who pays what. We sort of came from this world of wrap accounts where it was all packed into one neat 1.8% fee, 70 basis points, whatever it is. And now we're sort of starting to split it out, which makes it a little more confusing because the advisor has to decide, does the client pay this? How do I explain that I'm using this service and why they have to pay $500 an account? Because that fee doesn't include trading costs, correct? That's going to be additional.
Correct. Yeah.
That'll be sort of the additional piece.
We have two sets of portfolios. One, we can get into this later, but one of the sets has transaction costs associated with it, and one is built with ETFs that are no transaction fee. So those don't have the transaction costs.
So we alluded to this earlier. It sounds like you're more on the passive investment side. Is that correct?
Yeah, well, this was one of the things that was different about our firm from the beginning is I saw a lot of merit in the passive approach. I came from a history of being involved in active management. And so I had an interest in it and I'd seen it work before and a desire to make it work. But, there's this kind of religious gulf in the world, right? Where you've got passive people on one side and active people on the other. So one of the things that I thought was just different about our firm was that we made a decision to combine active and passive strategies. So our portfolios are built around a core, which is totally passive. And then we can add satellites to the portfolios, which may be passive. So some of our satellites are ETFs, but we can also add some actively managed funds if we want to. So we have, a few actively managed funds as part of our portfolios. We developed pretty quickly after we got out the door with that set of portfolios. We ran into a lot of people who said, hey, look, I don't like active management. I love what you're doing, but I'm not going to buy anything that has active management in it. So now we also have a set of portfolios that's just all ETFs. There's no active management at all. So we have those two sets, and both sets we manage on both a taxable and tax sensitive basis. So
okay, so it's really sort of, I guess we'll call it 4 models, but sort of grouped into 2. We've got a passive model, active model, and then each have a tax sensitive version. So are advisors able to say, oh, I want a little more REIT, and a little less small cap or whatever, or are you sort of tracking around this similar model for each client?
This is part of the key to, us being able to do what we do, right? If there's too much customization or too many hands on the dials, we can't really do this at the price that we're trying to do it at. So we have, for each one of these series of portfolios I talked about, we have 5 models. There's the less aggressive all the way up to the very aggressive models. And so we have different risk points at which we manage these, but we manage them ourselves on a discretionary basis, and there's no intervention from the manager or from the advisor. And so we do have some relationships where we do a little bit more collaborative work with the advisor, but those are not $500, an account portfolios.
So where do you see, I guess, for your own business model, do you see other service offerings or more flexible models in your future, that sort of thing, to sort of open it up? Or is the streamlining from sort of these, I guess, standard portfolios that you're working with really what's going to power your ability to scale? Really,
we're seeing, 2 parts of our business develop. There's the model portfolio part of our business where it requires a lot of efficiency, streamline, management of the portfolios, not a lot of customization and not a lot of intervention from the advisors. That part of our business is the primary part of our business. It's growing very well. Down the road, as we see opportunities to do other things, we'll take a look at those on an opportunistic basis. And we have a sub-advisory agreement coming up with a large firm, where we're going to take over management of some portfolios that they were doing. We've got a few advisors who have, pretty good practices who are really sick and tired of doing a lot of the back office work, really. And so they want to stay involved with portfolio management, but they want to offload all the back office stuff. So we're talking to them about putting some relationship together that would allow them, in effect, to join our investment committee. We have an awesome investment committee. We have 7 people on the investment committee with 5 CFAs and a PhD and a CFP. And, so it's a very talented group of people. And so what this particular advisor we're talking to wants to do is essentially work with the 7 members of our investment committee to work on his portfolios, and then we would implement the management of those portfolios. So that's kind of an off type arrangement. Mm-hmm.
No, that makes sense. And I guess that's what's interesting is that TAMP doesn't mean TAMP, right? There's so many variations. There's the fully outsourced. Literally, I'm just going to bring in the clients. To the point that I'm just going to refer, basically I'm sending you the client and you pay me a solicitation fee because I'm going to do nothing, all the way to I'm going to run everything in-house and I just need your models. And then everywhere in between. So it sounds like you're closer to the latter, not all the way to just give me your models, but you're doing the account management and rebalancing and things like that. But advisors are still maintaining the responsibility for, I guess, setting fees. I guess you're doing the rebalancing. They're doing account opening, that sort of thing.
Yeah. So the partnership that we have with advisors is really important because we rely on them to know their client, to work with their client. We view it as their client. It's not, we don't interact with the clients directly unless somebody asks us to. The client belongs to the advisor. And so the advisor is just bringing us the assets. We would typically open the accounts ourselves, do the performance reporting and the billing and all the administrative work. But the advisor's role is really the most important role here, which is to make sure that the client understands what it is we're doing and that their goals and objectives are consistent with the portfolio that we're managing for them. So there's a lot of, we don't actually have anything called a solicitation agreement here. It's called a joint advisory agreement. In our parlance, the advisor is very responsible for maintaining the interaction with the client. Our role is really to take care of a lot of administrative things along with the portfolio management.
All right. Yeah. So again, it's just really interesting to sort of see some of the changes that are happening. And recently, TD Ameritrade announced their iRebound marketplace, which then Riskalyze sort of announced a similar product that's multi-custodial. It sounds like others are going to be getting into this space shortly. So Kitsis wrote a good article recently, which I'll link to in the show notes, but just about the future of the TAMP. And it really is sort of separating the components because historically, and it sounds like, even the firms that you've worked with in the past, it really was the one-stop shop solution. And yet we have advisors that are starting to say, well, what if I want to pick and choose? Like I'm good at the back office, but I'm not good at this other piece, or I'm good at building my own models. I just don't want to implement them. Or I think SCI or, these DFA models are the greatest thing since sliced bread. So I want to be sure I have those for my clients. I don't know if you had a chance to read Michael's article on that. So do you agree with him? Did he get it wrong in any spot? And you don't have to debate him since I didn't have him on today.
Right on target. In fact, we passed that article around here in our office because I think he's really identified something that's an important change in the way our industry's working. And, there's a lot of unbundling of TAMP-like services right now. And so that's one of the cool things that we were trying to do when we started the firm here, was to sort of work in this new world where now a lot of what used to be done by the TAMPs, in the old days, or when all my other firms, we always had a back office, right? We had portfolio accounting system and, performance reporting systems and billing systems and all this software and a lot of staff that managed all of this. And now that we've outsourced all of that. So, part of our ability to charge a low fee for our services, that we've outsourced all of the back office work to Orion. They're our partner. And so they take care of all of that. And that allows us to focus totally on the two things that we really want to be focused on, where we can actually add some value. One is portfolio management, and then the other is providing a high level of service to the advisors we work with.
I think you just touched on the missing component that a lot of folks aren't thinking about, and that is just how much technology is streamlining the back office. I remember Kitsis and I did a joint presentation I think we were at TD Ameritrade for this one, but in one of the comments that he made was that when his firm, they were an early adopter of iRebound, which now TD Ameritrade owns, and that just by adopting that, they were basically able to avoid hiring like 7 traders.
Yeah, it makes a big difference. Yeah.
It's a huge difference from a staffing perspective. And now, again, iRebound is free to all TD Ameritrade users. And so for folks that are scaling and growing, I think he said they had 1 trader managing however many thousands of accounts Pinnacle has, which 10, 15, 20 years ago was unheard of. You would have had to have a whole team of people to actually do the calculations, do the trading, do the checking of the trades, and all of that. So that so much of the back office is being outsourced, and yet we haven't quite seen the pricing structure come down on the TAMPs. They tend to be very expensive.
Yeah, absolutely. Well, this is really kind of what drove us forward. Was we looked at the pricing structure, and some TAMPs are better at adopting technology than others. But, we realized that most of the major competitors in our space were hampered really by legacy technologies that they had. And they built their businesses around infrastructure and really thought processes which were sort of not very modern. And so we thought, well, we could make this move. It's, what we're doing here is something that any firm could do really if they wanted to. I mean, we don't have a patent on anything, but a lot of the more established firms have built their business on foundations which just aren't very flexible. And so I don't think they're going to be able to change quite as quickly as they might wish they could once we start taking off here.
Exactly. No, and again, I sort of feel the same way about XY Planning Network, where I was talking to a vendor recently, and I was trying to explain our business models. Like it's almost like a fee-only broker-dealer. Like if you took a broker-dealer and you stripped out the products and you stripped out the revenue share and FINRA, like you're kind of left with, with what we do. And so any broker dealer could get into the space and say, okay, forget this revenue share thing. We're just going to charge our advisors a flat $400 a month. And what's amusing is the most recent one that I saw was a broker dealer that continues to charge their percentage of revenue. Plus now they're doing a $200 a month platform fee. So they took our good idea and bastardized it, I guess, because they're just doing both.
Yeah. Well, this is what you see in financial services is a funny industry because there are people over here, who are in it to try to figure out how to make as much money as they can, maximize the opportunity to take a dollar no matter where they find it. And then there are some other people, who are over on the other side of the fence who approach the business a little differently and just say, hey, look, let's figure out how we can do the best thing for our clients and see if we can drive our business forward on that basis. And we'll figure out how to make money, so that we can support ourselves as well. The first thing that you think of is serving clients rather than making money for the house, and there you see different. That's why the business models look so different, I think.
Sure. And what do you want it to grow to be? If you were getting in this business to say, I want $28 billion under management, we're going to take on BAM, then, you might have not gone the flat fee structure. I don't know. I mean, maybe you still would have. It's just a very different model whenever you're trying to scale huge versus scale to just yourself or scale somewhere in between. So I do think it comes down to sort of being very clear on what you want to build, which is what we tell advisors all the time is like, don't tell me you want to scale and then complain that, you don't get to do financial planning anymore, because that's part of it. So like, be really clear about what you're trying to build, because the decisions that you make and the foundation that you lay it'll set the stage for what you're trying to become. Because it is possible to grow too fast. It's possible to grow faster than, the infrastructure that you've built. And the flip side, not growing as fast as you want because you didn't lay the right foundation. So, and it sounds to me like you want to grow, you want to scale this thing, but it doesn't, I'm not hearing that $28 billion is a goal in the next 3 years or anything like that.
It's not. No, one of the core ideas is to try to maintain service levels. And I don't know what your experience is, but I think, my experience is these days, whenever I'm dealing with a large organization, a really large organization, the client service is terrible. Whether it's a health insurance provider or a bank or whatever it may be. It's just, you get into these 800 number loops with, voice messaging things, sending you all over and choose from the menu and all that. And it's just the antithesis of what we're trying to do here. So I think there's a natural size limitation. You have to keep an organization within a certain size limit in order to be able to provide the level of service that, that we're aspiring to provide. And so, I think we're not thinking bigger is better. We're thinking better is better. We're trying to just do something where the service levels are consistently high, because, there's already people that want portfolios, from robo-advisor or digital service provider, that already exists, but we're trying to provide something that is, streamlined, low cost, but also has that high service component to it.
Yeah, I'm trying to remember the numbers I saw recently about Vanguard, and that I think they brought on like $350 million in December, but they're hiring 1,700 financial advisors for their call center because they grew too fast. And people are very ticked because, Vanguard doesn't want to be you get what you pay for. They are low cost, but they, pride themselves on actually picking up the phone. And they haven't been able to pick up the phone. So, it does, people think it's, growth is a good problem to have. It sounds good until you're the one in it.
Not always. I think that's exactly right. Yeah.
Like, 50 advisors show up on your doorstep as soon as this podcast goes live. That's actually not the happiest moment.
Yeah, it's not the happiest moment. No, it's really not. You really want to be able, and this is a point of differentiation. Our fee schedule is really easy to understand as a point of differentiation, but the service model is a point of differentiation for us too. We're very conscious about it. We don't want 50 people lined up at one time. That would not be a good thing. Yeah.
So anyone listening, you got to structure out your phone calls to First Ascent. So what are you guys working on now? Obviously, you just made this fee switch, and it would be hard for folks to miss the press that you got around it. Y'all do a fantastic job with your PR work. I guess is sort of the next little while just about sort of test running that, or do you have some stuff coming down the pipeline that you could share, or sort of where your focus is going to be? Yeah,
there's really two things that we're working on. One is to try to use technology to make the interaction with our firm more efficient and easier for advisors. So we actually just launched in January something we call our account onboarder. So if somebody wants to work with us, they can get a password to the advisor side of our website, and they can go over there and they can generate proposals, open accounts in an automated fashion. So, 24 hours a day, they could go over there without any intervention from anybody at our firm, generate their own proposals, open their accounts in a paperless fashion. These are things that robos do, right? But we looked at the robo technology and decided to develop our own version of it so that we could get exactly what we were looking for. So we have that automated functionality now in place, and we're going to continue to build on that. So, that gets better and better. And then the other thing that we're doing a lot of work on is if you go to our website, you'll notice there are a lot of videos on our website. And we're working very hard to try to interact with people through our website using video technology. So the traditional video that you see, in the financial services world is kind of a talking head, in a suit with, some skyscraper out the window behind him and going on about some facts and figures. We're trying to kind of take a different turn on that and really tell our story. We've actually developed our website. So it's for advisors, but it's also for their clients, So advisors can send their clients to our website and hear our story, understand what we're trying to do and how we're trying to do it. And they can hear about the fee structure, and they can hear about our investment process, and they can actually meet every member of our team and hear them talk. And one of the things that we're trying to do to make this whole fee thing work is to sort of abandon the traditional wholesaler approach to working in our marketplace. So we want to try to interact with people in different ways, more modern ways, I think, where people can decide when and how they want to interact with us. But the video technology is actually something that we're using a lot.
Awesome. Yeah. So did you build the account opening and all of that in-house, or is there some technology you've been able to leverage to get that functionality?
A fellow that I used to work with named Walter Gengarelli, I called him up and I said, hey, we want to build this technology. Walt, can you help us with it? And he did, and he formed a company around it. And so he's got his own firm, but we were his first, and as far as I know, his only client at this point. And he built it for us. And so so it's not technically something that we own, but it's something that we got from Walter and his firm. And so it's custom to our firm. We like the robo technology, some functionality of it, but what we didn't like was there's a lot there. We wanted to make something simple so that advisors could just go, generate proposals, open accounts, do those kinds of things without having to either go through or send their clients through, all of these processes where they're aggregating all of their accounts and giving the passwords to the, robos and, doing all of the things that, that are appropriate in certain circumstances, but really are kind of a diversion from what we wanted, which was just a clean path through the account opening process.
I love Walter's business approach of, hey, you need this, great, I'll build it for you and then sell it to a bunch of other people too, because you're going to build it once, might as well create customized versions. That's awesome.
So he's a brilliant guy, and I think he's going to build his company and be very successful, and we'll be glad to have been his first customer.
That's awesome. So final question, you mentioned that your son actually works at your firm. So I know we have a lot of listeners that are in firms with a parent or a sibling. Can you talk a little bit about family dynamics and how you, I guess, manage that piece? Is it just setting really clear lines and expectations? Or is it something just naturally, if you've got the right chemistry, it just sort of works for you?
Yeah, I actually don't think I'm a particularly good person to, espouse general rules in this area. I happen to be very lucky. I have a great son. We have chemistry that's phenomenal. We've worked together at my previous firm. We both worked there as well, and wonderful colleague in addition to being a wonderful son. And so it's just kind of naturally happened, I think, for us. I don't think either one of us has had to work very hard at it, and we're just lucky.
When I was 15, I worked at my dad's landscaping company, and I remember him sort of laying down very careful rules about when we're not at home, I'm boss, not dad. When you're here, your brother's the foreman, you have to listen to him. You don't come whining to me.
Yeah, it's happened pretty naturally for us. He doesn't call me dad in meetings. I guess that's the only thing I can say.
And that is really challenging. My mom is actually our bookkeeper, and it is really hard to refer to her as Rhonda. It is painful to, I grew up in the South where if I said, yeah, I would get in trouble. So it's always Mr., Miss, yes, ma'am, no, sir. And it's just funny to try to cross that up. But you slowly get used to it. But so as we're sort of wrapping up, I'll ask you my final question that I always ask guests, and that is, if you could go back to your younger self, and maybe this is, it could be the Scott that's thinking about starting, First Ascent. It could be further back than that. But if there's one piece of advice that you wish you could go back and give yourself, so that one thing you wish you had known then that you do know now, what do you think that piece of advice would be?
What I think it is just to try as early on as possible to figure out sort of who you are, what it is that turns you on and what motivates you and what your skill set is. The things that that we talked about at the very beginning, the things you like, the things that you really would like to be doing, the things that you're passionate about. Figure out what those are and find some way to just be as focused on those things as you can be. And don't worry so much about what other people, want you to be or think you should be or think the right thing to do is. It just finds some way to express whatever that thing inside of you is that's just gets excited when you wake up every morning. Find that person and spend all your time with that part of yourself. That's what I think. That just drives you forward then.
I love it. Well, Scott, thank you so much for taking the time to be on the show today and sharing your expertise and career path. It's been fun.
Yep, it's been great. Thank you very much for having me, Alan. I appreciate it.
If you'd like more time to spend with your clients, First Ascent Asset Management can help. First Ascent builds and manages investment portfolios for independent financial advisors and their clients for a flat fee of $500 per account. This industry-first approach to pricing makes professional investment management affordable for everyone without sacrificing quality. First Ascent's 7-member investment committee includes 5 CFAs, a PhD, and a CFP who collectively bring decades of experience, objectivity, and fresh perspectives. First Ascent offers a variety of portfolios designed to produce solid long-term performance while keeping internal expenses and trading costs low. First Ascent's high-touch service team stands with you as a resource to provide guidance and to make account opening and servicing the accounts easy and hassle-free. They also offer a streamlined technology platform to facilitate proposal generation and paperless account opening. Visit their website at firstascentam.com or give them a call at 720-465-7888. Be sure to join our VIP community at xyplanningnetwork.com/VIP to hang out with other XYPN radio listeners, ask questions for future mailbag episodes with myself and Kitsis, and to finally find a community of like-minded financial advisors. Thanks so much for joining me today. We'll see you next time.
You're not alone, and you're not crazy. It's scary starting, building, and growing your own financial planning firm. And that's why we put together a free private community just for you, the Cutting Edge Financial Planner. Go to xyplanningnetwork.com/VIP or text XYPN Radio to 33344 and join a network of thousands ready to change the lives of Gen X and Gen Y clients.